How's it going today, guys? Welcome back to the channel. I hope you're having an awesome day so far. So in this video here, we're going to be answering one of the most common questions that people are asking right now. And that is essentially whether or not this contagion that we're seeing here in the crypto market as well as the stock market, well, is that going to spill over into the real estate market? Now, of course, guys, nobody has a crystal ball, and I am no exception to that at all, but I do own real estate as the majority of my overall investment portfolio. So I do have a lot of insights I want to share with you about the real estate market right now, as well as how it relates and doesn't necessarily relate to the overall stock market. Now, before we dive in, I just have to mention that I am not a financial advisor. This is not any sort of financial advice, and you should always do your own research above and beyond this video before making any investment decisions. Also, this video is sponsored by Fundrise, but more on that later. So before we get into the nuances of real estate versus the stock market, let's start off by discussing why somebody would even invest in the first place. And it really comes down to this right here. Consumers lose purchasing power every year from inflation. And of course, this has become one of these buzzwords now that everybody is talking about, whereas pretty much for the earlier part of my life, inflation was just assumed to be this, 1 to 2% figure, and it wasn't something that anybody really talked about. Well, we've all gotten a quick trial by fire lesson here on inflation over the last year. And so just to show you guys what we mean here, from 1982 to 2022, the average inflation rate has been 2.9% annually, but it's been coming in at an annual rate above 8% in recent months. So as of May 2022, we had an inflation rate here at 8.6%. And just to show you guys an example of what inflation does to your money, well, $100 in 1994 is worth $200 in 2022. So another way to think about that is your $100 bill had 2 times the buying power in 1994. Now, I was born in 95, but that is still pretty close to my birth year, and it's kind of wild to think that in pretty much my lifetime, the purchasing power of the dollar has literally been cut in half. So that is why you invest, is to avoid having your purchasing power deteriorate. So we now know that investing your money in a strategy that makes sense over the long term is going to be a way to hedge against inflation. I think we also learned, over the last few years with different investment vehicles, whether it was altcoins, etc., not every investment out there is going to protect you from inflation, because if you make a bad investment, you can deteriorate all of your buying power much quicker than inflation will. But let's talk about sound investing strategies to protect yourself from inflation. So right off the bat here, with real estate and the stock market, you have to understand we're making an apples to oranges comparison here. So these are not two things that directly compare to each other very easily, and that is because each has unique tax, income, and cost implications, but we're going to be covering all of that in this video. I just want to make that statement here that this is not necessarily the easiest side-by-side comparison, and also clearly I have a lot of money in the stock market, I have a lot of money in real estate, I have a lot of money in private equity, and so the overall answer that most people will give you is that real estate and stocks make sense to be part of your portfolio, but we want to answer the question of right now, in this point in time, what is to be expected with the overall housing market. So let's jump right into that, starting off with some basics on real estate. So most people think of real estate as the single family house that you live in, but if you listen to people like Robert Kiyosaki that say your house is actually a liability, some people may not even consider that to be a real estate investment. This is typically what people are more so thinking about in the actual investment side of real estate, not so much, owning your single family home. Real estate investments are divided into residential and commercial investments. So this is going to be a very important delineation going forward for you to be aware of. So most of us are familiar with residential real estate. That includes single family, duplex, triplex, townhouse, and condo. And I believe a fourplex would actually still fall under the category of residential real estate. So even a fourplex would fall under that. Now, commercial on the other side is apartments, hotels, offices, retail, industrial, entertainment centers, that type of category there. So think of the difference here between residential and commercial in terms of apartment buildings as the number of units. So as we said, 1 to 4 units in that entire property, that's going to be a residential property. But anything more than 4 legal units, you're going to be falling into the category now of a commercial property. And then in the other category, we have different avenues that people use for exposure to real estate, which includes REITs or a real estate investment trust, as well as crowdfunding. Now, we'll be touching more on both of those later, so for now, let's go ahead and move on. So what are the pros of investing in real estate? Well, first of all, it does have the potential for passive income, which would be monthly rent in addition to the asset appreciation. Now, guys, I have been walking the walk and talking the talk, and I have been a landlord since 2019. And I will tell you, the monthly rent side of real estate investing is not passive income unless you fully have like a building manager and property manager, and they're collecting the rent and taking care of your taxes, and you literally at the end of the year get a call from your accountant saying, hey, here's the final dollar. Unless you're on that level, which I personally am not, real estate, the rental side is not passive. However, the asset appreciation I view as a very passive stream of income. And while historically that had been something, determined to be around maybe 5% annually, while sort of with this unprecedented monetary policy and things going on, we have seen some mega appreciation in the housing market over the last few years, and most expect that to continue going forward at least for the next 12 to 24 months. So aside from the passive income benefit, you also have the hedge against inflation, and that is because it's important to understand the relationship between real estate and inflation. Otherwise, you're quite possibly going to read this completely wrong. A lot of people had a bad experience in the 2008 to 2011 era in the housing market, so many of those people are now telling people like me that, hey, you have a property in Florida, you should get out. Now, they could be totally right. Nobody has that crystal ball, as we said, but if you look at the relationship between inflation and housing prices and real estate prices and rents, you can actually see, based on historical evidence, housing prices tend to increase as well as rents during inflation. Now, of course, that's a good thing if you already own real estate, and it's a bad thing if you don't, because it means if you don't already own it, it's becoming further and further out of reach. Now, of course, nothing can go up forever, and there will always have to be some sort of blow off here. Whether it's a 20% correction, it might not be as drastic as, the last housing market crash. But as far as when that point in time will be, nobody really knows for sure. And what interest rate are you going to pay? Certainly nobody knows that for sure either. So moving on, let's talk about tax benefits. This is one of the biggest categories for real estate. And I'll tell you what, I remember before I owned real estate, people would tell me about, hey, real estate has all these write-offs and tax benefits, and it's great if you're a business owner. And I didn't really believe them. But then when I owned real estate myself, and then every year when I sit down with my business partner and my tax advisor, they're the same person actually, with Investing Simple, we sit down there and we go through my real estate and all of these write-offs, and we take this huge piece of rental income that comes in, and I pay virtually zero taxes on any of that, and then I have write-offs that actually carry over and offset some of my other sources of income. So if you're a business owner, owning real estate should go hand in hand with that, because you have additional benefits that you really need to educate yourself on and become aware of. And then, of course, you have the ability for capital leverage, and we're not talking about calling up your broker and going on margin. This is actually what most determined to be a healthy form of leverage for the average person. So as we know, houses are pretty darn expensive, and so most people out there are not going to be a cash buyer, so you're going to go out and get something called a mortgage, which is going to allow you to get a loan from the bank to basically buy this asset. If you default, the bank secures your asset, so it's a relatively low risk scenario, as long as housing prices are not in a speculative bubble, and as long as you're not in something like an adjustable rate mortgage. Those are past lessons from the last housing market crash. But the leverage side of things that's important to understand is that you get to essentially lasso this asset for a very small amount of money, but you're fully in control of it. But the thing is, it's important to keep in mind that could go both ways, because that asset could both appreciate in value or depreciate. But if you do the right amount of research and you buy in the right market and you hold on to real estate for the long term, that leverage on your capital can be an excellent wealth multiplier. Now, of course, there are a lot of cons to owning real estate, starting off with the high investment cost. You need a lot of upfront capital to even get into the real estate game. So for example, and it's kind of silly to even say a $300,000 home, because now we're seeing an average closer to $400,000, but even using this on a $300,000 home, 20% down is still $60,000, and that doesn't even start covering things like furnishings and closing costs, et cetera, et cetera. There's many other factors associated with any real estate investment. So for a $60,000, down payment, you might need to have really $80,000 or even $90,000 to really get yourself situated in that house between all of your other costs. So we're talking about an individual or a couple maybe having to save up in the neighborhood of $60,000 to $100,000 now, I'd say would be the average amount of money set aside to even execute on your very first real estate transaction. Now, once you have that massive cash pile set aside, next barrier here is the high transaction costs. And that is essentially the commissions associated with a real estate investment. Now, me personally, I bought my first rental property, FSBO, for sale by owner, and I had an attorney that I worked with, and I paid him directly, and it was a much more difficult and time-consuming process, but it did save us that, 3% roughly in additional real estate commission there, so that's something that you can consider as well. But even beyond that, you're still going to pay any of your closing costs beyond anything associated with the listing, and you're talking typically about 3% of the total cost of the property is about what you would expect in closing costs. So for example, on that $300,000 house, after you get $60,000, which is basically the amount that you need just for the equity in the loan, add 3% for the other closing costs, which is going to be $9,000, and you're already up to $69,000, which is like the literal check you're going to have to show up at your closing with. And again, then you're going to have to make your mortgage payments, and then you're going to have to potentially, they should escrow your insurance, but there's other upfront costs. So basically it's a big amount of money that you have to come up with. So that is why it's so difficult for people. Also, it is a high time investment asset because finding a property and managing tenants require time. I'll tell you that when I was looking to buy my very first property, I literally spent a year and a half looking for the right one. And I probably looked at 10 different listings and just none of them were the right fit for me. And then I finally found, the property that made sense for me, and it checked off all of my boxes. But it can be very time consuming. And obviously every time I went to a showing and it went nowhere, that's sort of, a waste of my time and resources because it's not really going towards, making me any money or providing me a benefit. It was just looking at the wrong property. And then finally, low liquidity. And that's because selling a property is nothing like selling a stock. And that is because you have to list it. You have to make sure that you have all of your permits in order. There are so many things that could hinder a real estate transaction. You have inspections. You have all sorts of funny stuff that pops up during real estate closings and in between there. It's typically way before the closing. But anyways, it is not by any means a liquid investment. So that is a good thing and a bad thing, as we will learn later. So now let's give the stock market a fair chance here and see how that stacks up. So first of all, the stock market is a major umbrella that sort of covers all of these different investment options. You have individual stocks, which is where you invest in a singular company, where you're essentially a stock picker. You have ETFs, which is where you invest in baskets of different securities or stocks. You have mutual funds, which is where you pay someone to actively manage a fund that you invest in. And then you have index funds that basically passively track an underlying index and tend to be the best option for most people with the lowest fees. So those are the basic categories of the stock market. Now, what are the pros? Well, the stock market can be 100% passive income. So like, let's say, for example, you literally just want to derive income from $100,000. You could put your money into, for example, a Vanguard high dividend yield ETF and trust that your money is well diversified across, dozens, if not, I think it's actually hundreds of different companies on that particular ETF. So in that sense, it can be passive. But if you're going to be a stock picker, it is not passive, because that requires you to stay up to date and keep researching your companies and then keep researching new ones, because if a company you're investing in is taking the wrong turn, you might have to allocate that money elsewhere. So though it's not guaranteed, especially as we've learned in 2022, stocks can provide asset appreciation, and some of them also pay dividends. Now, another pro is that it's very easy to diversify. We didn't actually cover that so much on the real estate side, but if you buy one particular property and that's all you own, you're only have exposure to one real estate market. And a lot of people have been asking me if I think that there's going to be this broad housing market crash. I think there is going to be a correction of 20% at some point that's going to hit every market, but it's not going to be at the same time. So if you unfortunately bought real estate in the wrong market and you're not diversified, you could be way worse off than somebody who owns a real estate portfolio or a diversified real estate investment. With the stock market, lack of diversification is very much by design by you. So if you yourself want to put your money into concentrated positions, you have to basically understand the proportional risk that you are taking by doing that. You do have the pro here of high liquidity. You can sell your investments at any time, but that should also be a con. You can sell your investments at any time, because that's going to work both for you and against you based on the emotional responses that most of us, if not all of us, are susceptible to with the stock market. And then there is the low transaction cost here, and that is the fact that most brokerages now charge $0 in commissions. Paired with fractional shares means that the barriers to entry are lower than ever before. Now, of course, what are the cons? Well, the biggest one is immense amounts of volatility, and that is exactly what that clip art is showing us, which is the ups and downs of the stock market, and that is due to both internal and external factors. So that could be basically something affecting your individual company, and that could be something that's often more understandable for an investor. But when you have some external factor like runaway inflation or conflict overseas that is impacting your portfolio and dragging down your 401k, that is often a more difficult factor for people to wrap their heads around and really be comfortable with. And that's what often pushes a lot of people to diversify some of their money out of the stock market. Another thing that I always have been taught by people about real estate, and for example, my grandmother has always invested in a lot of real estate, is that if SHTF, so you guys know what that means, you could live in real estate. You can literally take shelter in it. How do you take shelter in a stock? Okay, so if you had, a $100,000 stock portfolio or $100,000 equity in a duplex, and then you lose your job, you can't go live in your stock portfolio, but you could theoretically if you could get rid of one of your tenants through eviction or whatever, take residence within your investment, meaning it can literally serve as a shelter for you. So we talked about how this ability to buy and sell at any time is really both a pro and a con, and that comes in right here with the emotional decision making. You are highly susceptible to making quick decisions, which often leads to panic selling and hype buying, which is going to be a guaranteed way to lose money in the stock market. You also have to consider capital gains taxes, and there's really very minimal benefits that investors have as far as tax incentives and tax benefits, especially compared to real estate. So you're not going to have those tax avenues and those different avenues that especially business owners look to capitalize on in the stock market. Also, leverage is high risk. So it's not like real estate where you can have any safe multiple or leverage on your investment. So now let's go through some comparison examples looking at real estate versus stocks. This is going to show you that the core advantage to real estate is leverage. It's that ability to take on safe leverage where you are multiplying your investment capital and lassoing a much bigger asset than the amount of money that you're putting in, giving you full control. But again, as we said, that could be good or bad because you can have both upside and downside to a potential real estate investment. But if, for example, it goes up, this is what it could look like. So real estate on the left. Let's say you have a piece of real estate with a $100,000 price. Now that's not very realistic, but we're doing a side-by-side comparison of that equivalent dollar amount going into the stock market just for a literal dollar comparison here between these two. So let's say on that $100,000 price, your $28,000 is your total investment, including 20% down, 3% closing costs, and then $5,000 in necessary repairs that you have to make. Let's say you're then able to rent that out for $750 a month and your mortgage is $530. Well, your monthly profit or cash flow would be $220 per month. Now, of course, this is a very simplified example, so do not rip my head off in the comments saying you're not accounting for wear and tear or setting aside money for replacing the roof every 30 years. I get that. Trust me, guys. I own a lot of real estate. We are simplifying it just to show you, a side-by-side comparison. It's impossible to, determine all of those costs for this example. This is just a ballpark figure. So anyways, your cash on cash return for this example is coming in at a 9.4%. And let's say you're looking at average annual appreciation of 3.8. So we're erasing the last 2 years of kind of outsized appreciation and saying, let's go back to the norm and a really low level of appreciation. So we're going to a very conservative figure here for average annual appreciation of just 3.8. So year one of earnings here, including your monthly profits and annual appreciation, is going to be $6,440. Now let's compare this to the stock market, and we're going to give the stock market its best chance here. So we are saying a $28,000 total investment, and we're using the average annual return of 10%. Now, anybody who invests will tell you that average annual return of 10% is by no means in a straight line, and you're going to have, at some point in time, at least a year, if not maybe 2 years, where you could literally be in the red on your entire portfolio based on the volatility associated with the market. But anyway, let's say it's a banner year and you get that 10% return, and let's say you also earned a 1.5% dividend, which would be about what you'd expect from the S&P 500, giving you that moderate enough risk to get a 10% potential return. Well, anyway, on that investment, your year one earnings of annual return and dividend yield puts you at $3,220, which is half of your return with real estate, largely, again, based on being able to have safe leverage, what most people would call safe leverage involved in the investment. So now I'd like to cover an example here of real estate depreciation, and this is pretty much the biggest tax advantage associated with owning real estate. And this formula right here, guys, is able to save you a lot of money that you could have ordinarily paid over in taxes to the IRS. And that is that annual depreciation is equal to, and the parentheses mean we complete this part of the equation first, purchase price minus land value multiplied by 3.636%. So let's go deeper into this and explain what these things are and where these numbers come from. So first of all, purchase price is pretty self-explanatory. That is how much you paid for the house, or if it is a multifamily property, commercial real estate, for example, if you bought like a large apartment complex, it would be the total purchase price for that complex. Next up, we have land value, which is using the fair market value of the land, and you can determine your cost basis in the property. Now, this land value is always going to be much lower than the purchase price, and I believe it's usually based on the assessed value from the county, but don't quote me on that one because I'm not entirely sure. But anyway, the land value figure is important to include in this equation as well. So you take purchase price, subtract land value, and then you multiply it by that figure, which is referred to as the MACRS, the Modified Accelerated Cost Recovery System. I will say, guys, this is getting a little deep in the weeds here, but I'll give you a very simple explanation at the end, so hang on for one more second. Okay, this is simply an accounting technique that spreads costs over 27 and a half years. Another term that you might have heard for this is called amortization schedule or amortized depreciation. And depreciation is simply writing off the amount of this asset that has basically lost its value. Now, this is sort of a weird thing here because we know that real estate actually goes up in value, but believe it or not, the IRS lets you write off the devaluation of your real estate. Now, you are going to run into something called depreciation recapture at the end, but if you don't sell a fully depreciated piece of real estate, that is something that you may not run into. So again, I could do a full video just on depreciation, but I just wanted to cover some of the basics here, hopefully to pique your curiosity about these tax benefits that are out there. So let's cover an example here of that real estate depreciation, okay? So the annual tax deduction in this particular case would be from taking $300,000, which would be your purchase price, and let's take the land value, let's say it's $30,000, and multiplying that by 3.636%, because basically what it comes down to is you can't depreciate land because land itself just cannot lose value, but any structures on land, buildings, dwellings, etc., the IRS allows you to depreciate those things. So that's why you have to net the land out of that equation, just for explanation's sake there. But anyway, this would give you an annual tax deduction of $9,817. Now, before you get super excited and say, wow, I can't wait to be a homeowner and get my annual tax deduction, man, it does not apply to single family real estate if that is your residence because you're not renting it. And so you can't depreciate it. Now, if you do what I did, which is how I got into real estate through house hacking, you basically live in part of the real estate and rent part of it out. And then you simply take your square footage and you just do it on a percentage basis. So for example, when I used to occupy my rental in upstate New York, I was able to take like 47% of different costs and use that because that was the rental side or rental percentage, and 53% of the square footage was the owner's part, which is not being able to have any write-off associated with it except for my business write-offs like home office, etc. So long story short, this would have to be a rental property. If you bought a single family house, rented it out to someone else, that would be your annual tax deduction. So we said now the key advantage to real estate is leverage, and then maybe the secondary one is that depreciation. What is the key advantage to the stock market? Well, this is basically two things. Number one is the advantage of liquidity, and number two, the ease of investing in diversified portfolios. So again, with real estate, buying an individual property, it's very difficult to diversify unless you're going to buy dozens of properties all over the place. Well, with the stock market, you can invest in the S&P 500 in under 5 minutes and own the 500 largest publicly traded companies in the United States. And you can also trust that ETF is going to be rebalanced on a period and all automated. You don't have to involve yourself whatsoever in that process. You have a high level of diversity, you have low transaction costs, and you can literally sell whenever you want, assuming the market is open. With, again, the diversity side of things, it's easy to invest in baskets of stocks, or you can basically buy a bunch of stocks through fractional shares if you wanted to and build your own diversified portfolio. Compare that to owning directly, buying a house, or buying an investment property. It's a 3 to 6 month home buying process with low diversity, high transaction cost, and a lengthy process to sell. However, typically what I have found in life is that the higher the barriers are to entry to a given opportunity, the more upside there is. And that's simply because the more difficult something is to do, the less people are actually going to go out and do it. So now I'd like to talk more about a company that I have worked very closely with since 2018 and today's video sponsor, which is none other than Fundrise. Simply put, what Fundrise does is it takes a lot of these traditional downsides associated with owning real estate out of the equation. Let me show you right here. These are the cons of owning real estate that we already covered. Let's now compare this to Fundrise and then talk more about them. Starting off with high investment costs. We already said you should expect to have about $60,000 set aside just for the equity required for your loan. Well, with Fundrise, it is literally a $10 minimum to open up an account with them and begin investing in portfolios of commercial real estate. We talked about the approximate 3% closing costs associated with owning and buying real estate directly, while Fundrise has a 1% annual fee. We also talked about the high time commitment and investment in scouting properties, finding properties, etc. Fundrise is completely passive. It is managed by a professional real estate team, meaning you can invest in minutes and then it's completely hands off. And then lastly, as far as the low liquidity, Fundrise does have an easy redemption request policy where you can request quarterly redemptions. However, there are early redemption fees to be aware of, and I am going to speak on those shortly. Now, a banner year in particular for Fundrise was 2021, and that was the year that we came out of this global pandemic. So a lot of people didn't know what was going to happen, and for a period of time, Fundrise did suspend redemptions, as they do have a right to do that, and that is based on the fact that they're investing in portfolios of real estate, commercial buildings. And so if people are all trying to pull their money out at once, they need to protect the interests of the other investors and keep that money in there. So although they did freeze redemptions, they opened them back up shortly thereafter, and there wasn't really a big wave of people trying to exit. Now, those who stayed in for 2021 were rewarded handsomely, and Fundrise accounts gained 23% in 2021. Now, we already talked about some of this erratic behavior in the market based on record fiscal stimulus, so you would be incorrect to assume or even think that this is going to happen, every single year or even again. But I've learned it's always important to look backwards, and that gives you a rough idea of what might happen in the future, and Fundrise does have a long history now of consistent returns through real estate. With Fundrise, you can join over 300,000 active investors, and you can trust the Fundrise team that has completed over $7 billion in total real estate transactions. And if you're a fan of dividends, which can be automatically reinvested back into Fundrise to earn compound interest, well, they have paid out over $160 million in total dividends earned by investors. It is low cost, quick, and easy to set up with a high level of diversity. Now, as I mentioned, I have been working with Fundrise closely since 2018, and that is when I became a Fundrise investor myself. So I started investing in Fundrise following the strategy of dollar cost averaging or just regularly contributing money to my Fundrise account. So through doing that, over the next few years, I ended up investing a total of $25,000 into my Fundrise portfolio. Now, in November of 2021, I decided to redeem my shares in Fundrise because I wanted to make another real estate purchase. I liked having my investment in Fundrise, but I wanted to purchase a piece of land, and so for me, I liked the idea of pulling my money out of one real estate investment and putting it into a different one, and it was a very easy process. Even with the early redemption fees that I did pay, and I'm going to tell you about that shortly, I personally had a positive return with Fundrise of $1,948.86 over that multi-year period investing with them. Now, since I ramped up contributions over time, calculating that return might be a little bit difficult because, for example, I only started with $1,000, but I overall made money with Fundrise, and even though I did pay $800 in penalties, it was still almost $2,000 of a positive return. Now, on that redemption penalty, basically, Fundrise wants you to commit to this being a 5-year time horizon investment, and make no mistake, any real estate investment for the most part should be viewed as such. So as a result, the approximate penalty, if you're redeeming before the 5-year mark, is about 1% of the total value of your shares. But if you simply wait till beyond the 5-year mark, there is 0% penalty associated with redemptions. So that brings us to the final question: which investment is right for you? If you're thinking about direct investment into real estate, for example, like going out and buying a rental property, this is what a side-by-side comparison would look like compared to the stock market. There's going to be a huge time commitment with that real estate investment, not so much with the stock market, especially if you follow a passive strategy. You're going to have a high degree of liquidity with the stock market, and the real estate is not very liquid at all. As far as the costs go, stock market is going to be a low-cost investment with low barriers to entry. That is not the case with real estate. You need tens of thousands, if not $100,000 these days to get your hands on some real estate. Both could be an inflation hedge, but we know that real estate has done a hell of a lot better than the stock market so far in 2022. Now, of course, there's bits and pieces of the stock market that have done well, but I'm, of course, talking about the overall return of the major indexes. As far as leverage, real estate gives you safe, in most cases, what most would call safe leverage on your asset. And you can't really have safe leverage in the stock market without taking on humongous amounts of risk. And then there are a lot of tax benefits and savings associated with owning real estate that you just do not have with the stock market. Again, if you want to check out Fundrise, our video sponsor, they're able to give you a unique investing experience combining both the benefits of the stock market with the real estate market, giving you all of these. You have low time commitment as it is passively managed, easy liquidity with the option for quarterly redemptions. You have a low cost option because it's a $10 minimum investment with a 1% management fee. It is well diversified. It has proven to be a hedge so far against inflation. It is a safe amount of leverage that is managed by real estate experts, and you still get tax savings associated with owning that real estate. So if you guys would like to check out Fundrise, there's going to be a sponsored link down in the description below, and there's also going to be a pinned comment where you can learn about how you can begin investing in diversified portfolios of commercial real estate with as little as $10. Anyways, guys, I hope you enjoyed this video here looking at the stock market versus real estate. If you're new to my channel, make sure you subscribe and hit that bell for future notifications. And as always, I hope to see you guys in the next video.